Hello and welcome to this video on the future of the global economy. Over the past few decades, we've seen tremendous changes in the global economy, with the rise of emerging markets, the increasing interconnectedness of the world's financial markets, and the impact of technological advancements. But what does the future hold for the global economy? One of the key trends to watch is economic growth. In the past, economic growth was driven largely by population growth and technological advancements. However, in recent years, we've seen a slowdown in global economic growth, and some experts predict that this trend is likely to continue in the future. This could be due to factors such as declining fertility rates, aging populations, and slowing productivity growth. Another important trend is trade. The global economy is highly interconnected, with countries relying on exports and imports to fuel economic growth. However, we've seen a rise in protectionist trade policies and tensions between major economic powers in recent years, which could have negative impacts on global trade and the global economy. Finally, technological advancements are likely to continue to shape the future of the global economy. From automation and artificial intelligence to the rise of digital currencies and blockchain technology, these developments have the potential to disrupt traditional economic models and create new opportunities for growth. So, what does all of this mean for the future of the global economy? It's difficult to say for certain, but it's clear that there are both challenges and opportunities on the horizon. It's important for governments, businesses, and individuals to stay informed and adapt to these changing circumstances in order to ensure a prosperous and sustainable future. In recent years, there have been a number of developments in the global trade landscape that have had an impact on the economy. One major development has been the rise of protectionist policies, with countries imposing tariffs on imported goods in an effort to protect domestic industries. This has led to tensions between countries and has the potential to disrupt global supply chains and harm international trade. On the other hand, there have also been efforts to improve global trade and promote cooperation between countries. The signing of new trade agreements, such as the US-Mexico-Canada Agreement and the Comprehensive and Progressive Agreement or Trans-Pacific Partnership, has the potential to increase trade and boost economic growth. It's important to keep an eye on developments in global trade as they can have a significant impact on the economy. For example, changes in trade policies or the signing of new trade agreements can affect the prices of goods and services, as well as the availability of certain products. Overall, the state of global trade is an important topic to keep an eye on and can have far-reaching effects on the economy. Defining what CBDCs are. Simply put, CBDCs are digital versions of traditional fiat currencies, such as the US dollar or the euro, that are issued and backed by central banks. They can be used for a variety of purposes, including making payments, storing value, and transferring money. One of the key advantages of CBDCs is that they have the potential to increase financial inclusion, especially in developing countries where access to traditional banking services may be limited. They can also potentially reduce the cost and complexity of financial transactions, as they can be easily transferred and settled digitally. Another potential benefit of CBDCs is that they could provide a more stable and reliable store of value than some cryptocurrencies, which are prone to volatility. Additionally, because CBDCs are issued and backed by central banks, they may be perceived as being more trustworthy and secure than some decentralized cryptocurrencies. However, there are also a number of potential risks and challenges associated with CBDCs. For example, there are concerns about the potential impact on financial stability, as well as the potential for CBDCs to be used for money laundering and other illicit activities. There are also questions about the role of central banks in managing the issuance and circulation of CBDCs, and how this might affect traditional monetary policy tools. Despite these challenges, many countries around the world are exploring the possibility of issuing their own CBDCs. The People's Bank of China, for example, has been testing a digital version of the yuan, while the European Central Bank is also considering the possibility of issuing a digital euro. In conclusion, CBDCs have the potential to bring significant benefits, such as increased financial inclusion and reduced transaction costs. However, there are also a number of risks and challenges that need to be carefully considered. It remains to be seen how widely adopted CBDCs will be in the coming years, but they are definitely a trend worth watching. Some of the main challenges and potential risks include financial stability. There are concerns that the widespread adoption of CBDCs could have unintended consequences for financial stability. For example, if a large number of people suddenly switch from holding traditional bank deposits to holding CBDCs, it could lead to a significant reduction in the amount of deposits held by banks, which could in turn affect their ability to lend and potentially lead to a credit crunch. Money laundering and illicit activities. CBDCs could potentially be used for money laundering and other illicit activities. as they can be easily transferred and settled digitally. This could pose a challenge for regulators and law enforcement agencies trying to combat these types of activities. Privacy. CBDCs could potentially pose a threat to privacy, as they could potentially be used to track and monitor the financial transactions of individuals. This could be a concern for people who value their financial privacy. Impact on traditional monetary policy tools. CBDCs could potentially affect traditional monetary policy tools, such as interest rates and quantitative easing, as they could provide an alternative means of providing liquidity to the financial system. This could make it more difficult for central banks to manage the money supply and stabilize the economy. Despite these challenges, there are also a number of potential benefits and advantages to CBDCs. For example, increased financial inclusion. CBDCs have the potential to increase financial inclusion, especially in developing countries where access to traditional banking services may be limited. They can also potentially reduce the cost and complexity of financial transactions, as they can be easily transferred and settled digitally. More stable and reliable store of value. CBDCs may be perceived as being more stable and reliable than some cryptocurrencies, which are prone to volatility. This could make them a more attractive option for people looking to store value. Trustworthiness and security. Because CBDCs are issued and backed by central banks, they may be perceived as being more trustworthy and secure than some decentralized cryptocurrencies. This could make them more appealing to people who are hesitant to use cryptocurrencies due to security concerns. Interest rates and monetary policy. Interest rates are a key factor in the economy, as they affect the cost of borrowing and the value of financial assets. Central banks around the world use monetary policy to manage interest rates and achieve their economic objectives, such as maintaining price stability and supporting economic growth. So, how do central banks manage interest rates? One way is through the use of a benchmark interest rate, also known as the policy rate. This is the rate at which central banks lend or borrow money to or from commercial banks. By setting the policy rate, central banks can influence the cost of borrowing for households and businesses, and thus affect economic activity and inflation. For example, if a central bank wants to stimulate economic growth, it may lower the policy rate to encourage borrowing and investment. On the other hand, if the central bank is concerned about inflation, it may raise the policy rate to discourage borrowing and cool down the economy. Central banks also use other tools, such as asset purchases and communication, to influence market expectations and influence the behavior of other interest rates, such as those on government bonds or mortgages. It's important to note that monetary policy is not the only factor that determines interest rates. Other factors, such as the level of risk in financial markets, the supply and demand for credit, and the overall state of the economy, can also affect interest rates. So, what does all this mean for you as a consumer or investor? Interest rate changes can have a significant impact on your financial decisions. For example, if interest rates are low, it may be a good time to borrow money or refinance your debt. On the other hand, if interest rates are high, it may be more expensive to borrow, and you may want to consider saving more or investing in assets that offer a higher return. It's also important to pay attention to the direction of interest rates, as they can affect the value of your investments. For example, if you own a bond, the value of your bond may go up if interest rates fall, but it may go down if interest rates rise. In conclusion, interest rates and monetary policy are important factors that can have a big impact on the economy and your personal finances. By understanding how they work, you can make informed decisions about your financial choices. Inequality and social justice. Inequality and social justice are important issues that are gaining increasing attention in the economy and finance. Income and wealth inequality have been on the rise in many countries, and there is growing concern about the impact of this trend on individuals, communities, and society as a whole. So, what is inequality and why is it a problem? Inequality refers to the unequal distribution of resources, opportunities, and power among different groups in society. It can be measured in various ways, including income, wealth, education, health, and access to services and resources. Inequality can have negative consequences for individuals and society. For example, people with lower income or wealth may have limited access to education, healthcare, and other opportunities, which can affect their health, well-being, and long-term prospects. Inequality can also lead to social and political unrest, and may undermine trust in institutions and social cohesion. So, how can we address inequality and promote social justice? There are many different approaches to addressing inequality and promoting social justice, and different countries and communities may adopt different policies and strategies. Some common approaches include progressive taxation. Taxes that are higher for higher earners can help to redistribute income and wealth and support social programs and services. Education and training. Providing access to quality education and training can help to increase opportunities and reduce barriers to social mobility. Social protection. Programs that provide support to vulnerable or disadvantaged groups, such as children, the elderly, or those with disabilities, can help to reduce poverty and improve well-being. Labor market policies. Policies that promote fair wages, working conditions, and job security can help to reduce income inequality and promote social justice. It's important to note that addressing inequality and promoting social justice is not just a matter of public policy, but also requires broader social and cultural changes. For example, addressing discrimination and biases, promoting inclusivity and diversity, and fostering a culture of fairness and solidarity can all contribute to greater social justice. In conclusion, inequality and social justice are important issues that are likely to continue to be prominent in discussions about the economy and finance. By understanding the causes and consequences of inequality, and by adopting policies and practices that promote social justice, we can work towards a more equitable and inclusive society. Thank you for watching. I hope you found this video informative and useful.